now, or we have entered in the last few months, has been very, very complex. Total global uncertainty, extreme fear, changing contours. Nobody knows where are we heading. In such an uncertain world, how do you make policy? And monetary policy of all, because the transmission mechanism of the monetary policy is so long, needs so much of seamless markets, and is just operating through a single instrument interest rate. It's, I think, a very complex issue. Given the complexity of the issue, we found a paper from the BIS talking about monetary policy decision making and communication under uncertainty. And this is an insight from a survey of central banks. So we thought this is fabulous and it's going to be useful for macroeconomic policy making. So we invited them to come and please present their paper. And we are fortunate that they agreed to do so. So we have Eduardo and Shim, hope I pronounced your name properly, to come and present their research. To chair the session, we have two chairs. We have Hans Genberg, a dear friend of mine. We work together at the IU of the IMF. And he has been in this part of the world now for nearly 8 years. So he knows how all this is happening, and he is with the central bank here. Steve is a dear friend of mine. While I was at Harvard, we used to interact a lot. I've known him for years now, and he was the chief economist at the BIS. Now we are talking of monetary policy decision making and communication under high uncertainty. So we have two friends from India, Professor Shashanka Bhide, who was member of the Monetary Policy Committee at the RBI. And we have Mr. Anil Sharma, who was the executive director in charge of communication. So bringing both of them in, the decision making and communication under high uncertainty. With this brief introduction of EGROW and the speakers, we are going to follow the following pattern. We are going to be inviting Hans first to come and speak. Then we have Steve, who will also share his thoughts, initial remarks, pose questions. Then we go over to the speakers. They present their thoughts. And then again, both the chairs, the way they want to react to the speakers, and then invite the discussants. And once the discussants have come in, about 10 minutes each for the discussants, again over to the chairs, how they want to go ahead. If there is time permitting and both of them are willing, then we could have question answers from the floor. Otherwise, we'll move ahead and close the session. So with that, welcome you, Hans, welcome Steve, welcome Eduardo and Shim and Shashanka and Anil. I hand over the session to you, Hans, now to take the proceedings further. Hans.
I will continue, assuming that you hear what I'm speaking about, saying. as Sharma mentioned, and so I'm quite involved. The question of uncertainty and how it affects monetary policy and policy in general has been studied in the literature for some time. And let me just very some of the main things. Back 1960, William Brainard wrote an article on uncertainty and the effectiveness of monetary policy, where he argued that if the effects of monetary policy, in the formal sense, the parameters in an economic model are uncertain, then the appropriate response of or mentioned, this was a case of uncertainty about model parameters, but subsequent research showed that if the uncertainty is about other elements that monetary policy needs to be taken into account, in particular about things like inflation, be important in some context to be more anchor expectations around the inflation target that the central bank has had. Another example is, I think, even the European financial crisis was and that we will do all that it will take to keep the union together. In other words, no cautiousness there, very aggressively saying that what they would do in case it was needed. So that the attenuation principle or the cautious principle of Brainard really depends a little bit on where the uncertainty about facing the central bankers come from. Then later on in sort of the early 2000s, Hansen and Sargent applied a concept from engineering, essentially the robust control theory, to monetary policy, and applied it in a way of by saying policy will be the least bad in the case of uncertainty about the model itself. What kind of model is describe the economy? And in that context, they showed that it is often the case that policy should be more aggressive in those circumstances. So these were cases where in the quantified by some probability distribution around about the parameters in a model. In the Hansen and Sargent setting, it was more about unquantifiable Knightian uncertainty, or Irving King and his co-authority. Now, that also mentioned in the survey, and that is survey scenario analysis planning. And that is an approach where policy set of meaningful scenarios. And then they ask themselves, under these scenarios, what would be the most appropriate that. So I can think of it, what would keep us under this, out of trouble if across these various scenarios. Now, this is a bit like contingency planning. And central banks often speak about using scenario planning in their communication. How do you communicate which could be very disadvantages for the economy and not scare the markets into unusual and disingenuous action. So I think in all cases relating to uncertainty or the kind of scenarios that might come about, the communication issues, I think, are critical. And I won't try to that I think it's critical that the objective of the central bank, what they're trying to achieve, is clearly stated. For instance, okay, so he said we will do whatever it takes. That avoids trying to specify what kind of very unusual but plausible scenarios that, while at the same time in the under such scenarios. So I think I'd be interested in hearing from the authors of the paper what were in the case of communication of certainty. I'm looking forward to certainly the presentation of the paper as well as Steve's view of these matters. Thank you. That is it for me. Thank you very much.
Steve?
Thank you very much. Thank you very much, Sean, and thank you for inviting me to this event. It's lovely to see you. It's also, I also always enjoy interacting with my former colleagues at the BIS, especially with Ilhyock, who I worked with quite closely when he was working in Hong Kong. This particular piece of work, which we're going to hear about, I think is a very nice summary of what a number of emerging market central banks are currently doing in their approaches to managing uncertainty. And it's important to keep in mind that what they're doing is largely descriptive. They have a very nice survey. This is what one of the many things that the BIS is extremely good at. It's good at getting central banks to answer their surveys. And this is an example of that. And in this, they are discussing how policymakers are addressing this in both decision making and communication. Obviously, these are quite connected. I have a number of comments about this that are more proscriptive, maybe, and so let me make them. I want to start with some preliminary points about uncertainty and communication. On uncertainty, I'm reminded of my experience at one of the first conferences I attended at the newly constituted European Central Bank in early 1999. The host was the great German central banker Otmar Issing. And Otmar started the conference by noting that the title of the conference was Monetary Policy Under Uncertainty. He then paused and looked at all the participants and asked, is there any other kind? So the first point is that monetary policy makers, and in fact, all policymakers really, all policy making is really about managing uncertainty. That's their job. That's what they're doing. And so this is really asking what to do, how to run monetary policy without considering uncertainty doesn't make any sense. Now, the second preliminary point is about communication. Effective monetary policy communication, I think, serves a critical accountability mechanism for central banks. And it also, I think, makes policy more effective. But central bank communication requires a certain kind of discipline, and that is speaking only when it's necessary, using clear language, and being transparent about the limits of your knowledge. And when policymakers, there's sort of three core objectives then that emerge. So the first is to simplify public statements. The second is to clarify how policy reacts to changing conditions. And the third is to highlight policy uncertainty and risks. I think it's important, however, to keep these separate. And most importantly, it's important to keep in mind that there's one source of uncertainty that policymakers can, in fact, control, and that's themselves. That is, they should not be a source of noise. The only source of uncertainty should be economic and financial environment, and that's exogenous events. So let me make a couple of comments then about three more specific things. The first is the central goal of communication. The second is forward guidance, which I think is quite confusing and people misuse generally, at least in my view. And the third is about the core of what the paper we're going to hear is about, which is the challenges that are posed by uncertainty. So on communication, I think the overarching communication goal is enabling financial markets and the public to react to economic data rather than to policymakers' statements. Ideally, market interest rates should move with data releases, with policy decisions just validating those changes. Publication of policy decisions should, in effect, be uneventful, with volatility arising from external shocks, as I suggested, rather than the central bank reactions to the data. While specifying and publishing mathematical policy functions might be ideal, it proves completely impractical. This is something I think that's noted in the nice paper we're going to hear. The reaction function is going to evolve over time as the economy's structure changes, policymakers' knowledge improves, membership of policy committees changes. That's going to cause the reaction function to change. And finally, society's preferences. So a timeless reaction function lacks credibility, but changing the reaction function too frequently also is going to undermine credibility. So in trying to ensure that everyone understands how you're going to react, policymakers have to walk this sort of fine line. Let me make a side comment really about forward guidance, which is related to uncertainty, of course. Many central bankers seem to believe that forward guidance is important and they try to do it. But I think that they fail to distinguish often between two types of forward guidance. The first is projections, which represent statements about the outlook, what policymakers believe is most likely given the assumptions about various conditions. These reflect, I think, an interest rate path that's consistent with the central bank's reaction function. The second is commitments by these are guarantees about future interest rate paths. I think the problem that exists is that it's very easy for markets and the public to confuse these two. And so in my view, central bankers should use forward guidance as a commitment only when policymakers wish to provide stimulus beyond what occurs when markets anticipate normal responses, and that this should be relatively rare. The challenge then is that, as I said, markets and the public often interpret any statement about future actions as a commitment rather than a projection. So I think it's important then to shy away from making projections about what you're likely to do, and instead just simply make statements about how you're going to react. Finally, then, let me come to the crux of what we're talking about going forward today, and that is communicating uncertainty. Here I find Mervyn King's guidance on this very instructive. Mervyn said, talking very openly about the degree of ignorance is crucial. Explain what we don't know and don't apologize for it. This is being honest, and frankly, no one else knows either. So I think there are several compelling reasons then to support communicating uncertainty. A number of these I think are discussed in the paper, so we'll hear about them again. The first is to build trust, and the second is to demonstrate expertise. The third is to enable flexibility. The fourth is to manage expectations. And the final one is to support risk management. Now, in doing this, then what are the tools that you have? And how is it that you're going to do it? My answer is that you should use a combination of tools, most of which are discussed at length, some length in the BIS paper and in the volume that it introduces. So the first one is fan charts. I think people have shied away from fan charts. Unfortunately, I think that these things should be used in combination. Fan charts, I think, provide an intuitive visual representation of a probability distribution. They reduce false precision from point forecasts. Now, these can be constructed in a number of different ways. I mean, I think that stochastic simulations of macroeconomic models is probably the best way to do it, but that can be quite hard. So maybe historical forecast errors is the best way to do it. But fan charts excel at communicating what I would call normal uncertainty, the central portion of probability distributions, but they don't effectively convey how policymakers will insure against seriously adverse events. And here's where I think there are two other techniques. One of them is growth at risk, or what I call GDP at risk in my original paper from 2005. This draws on this value at risk concept from risk management, and it answers the question, in a bad but plausible scenario, what GDP growth might we experience? Policymakers can present baseline projections alongside central distributions with fan charts, and then look at downside tails using these other techniques. And this can justify insurance actions that are basically insuring against these downside risks. Now, what's become popular recently, and I think maybe too popular to the exclusion of these other techniques, is scenario analysis. These are very valuable because they provide internally consistent paths that are conditional on specific events. But those events, like higher commodity prices, a global recession, or financial stress, the sorts of things, or possibly large exchange rate movements that are important for emerging market economies, those are only some of the things that can happen. So the choices of these scenarios has to be done very carefully, but you can only use a few of them, which is why you need these other techniques as well. So scenarios, though, do make uncertainty concrete and accessible. But importantly, they're not probabilistic. They provide no information usually about the likely responses to small deviations from the central tendency. They tend to be quite resource intensive, and they might cause policymakers, and this is my main worry, to ignore other important possibilities that could occur. So I would be very careful with scenario analysis, and make sure that it's a complement to what you're doing and not a substitute. And this is where I, as I said, I'm very concerned. And I should make one more comment, which is that I hope that emerging market countries do what's best for them, not just following what advanced economies are doing. Let me stop there and say that I'm very much looking forward to hearing from Ilhyock and Eduardo about the work that they and their colleagues have done.
Okay, thank you, Hans and Steve. maybe I can proceed. So first of all, I'd like to thank the EGROW Foundation for inviting me and Eduardo to present this work that the BIS Americas office located in Mexico City has been doing last year. So before I start, I should make it clear that these are the presenter's own views, not necessarily the official BIS views, although this one heavily draws on the BIS member central bank's survey response. So I guess I should probably start giving you some idea why this thing has started, this project. So about this time last year, the BIS Americas office, we had a new chair for us committee, or I can say standing working group called Consultative Group of Monetary Policy. So this group consists of deputy governors or head of monetary policy in BIS member central banks in North and South Americas. We have 8 jurisdictions, 9 institutions, the New York Fed plus the Fed board. And those, this committee has been thinking about, because it's a very young committee, it only started 2024, and they thought about a sort of a special project. And the chair was thinking about what kind of projects. And then, yeah, we thought about it, and around March, April last year, it became quite clear the central banks are facing unusually high levels of uncertainty, something similar to what we have seen like GFC or COVID kind of level. So there was sort of a choice, and there was survey designed, and central banks, as Steve mentioned, gave very good effort to respond to those surveys, and then we processed and prepared the article. So high level of uncertainty in 2025 was definitely the major trigger of these questions. Of course, as Steve mentioned, and also Hans mentioned, uncertainty has been always with central banks, but there was agreement among the members of that committee, Consultative Group of Monetary Policy, that this time seems to be unusually high uncertainty from different sources of shocks and so on and so forth. So that was the starting point of the whole project. And from the beginning, we tried to make it very clear, this initiative or exercise is not about academic or just about decision making. We really wanted to go through the whole process as is at the top of the slide here. So uncertainty affects analysis, and then based on that, central banks internally have different levels of deliberations, making decisions, and then communicate. And communication goes to different types of audiences. So we wanted to go through this process very carefully and try to see how central banks are potentially changing their internal practices, and also what they think about how to change their communications when they face very high levels of uncertainty compared to normal uncertainty. So this was the motivation of the whole exercise. And because of that, we actually looked at the challenges in terms of internal central bank practice, decision-making, and communication. And the key objective of the survey was how actually central banks has adapted the decision-making process and communication strategy, and what kind of tools they think are more important under extremely high uncertainty, and also what kind of lessons they have learned. And again, this initiative was from the central banks in the Americas, but the initial, so what the group's thinking was what the group has been doing from North and South Americas can be potentially useful for central banks in other regions. So let me move on to the next slide. So when we were trying to construct this survey, I should admit that initially Eduardo, myself, and the courses, we started from about 100-something questions, and we quickly figured out, I'm sure Steve understands, the trade-off between many questions and the high quality of responses. And central banks do often complain about the burden of providing, I would say, very good answers. So we actually came down all the way to 41 questions, which we think are important. And in the survey questions, there are 6 sections, as you see in the third bullet on the slide. So we have this analysis and modeling part, scenario, reaction function, board guidance, and communication, more or less following the process I described in the previous slide. And in this exercise, we have, again, 8 jurisdictions under the BIS membership in the Americas, and we invited 2 other central banks in the region, but not the members, and also central banks in Turkey and South Africa were also invited to join. So 12 central banks participate in the survey. So this one is, again, predominantly Americas, especially in terms of number. It's more Latin America sort of views, but it does include other emerging markets view. But I should also emphasize that Canada and the United States, the Fed, has actively participated in the survey. And in terms of designing the questionnaire, which is actually in the paper published already, we have mostly multiple choice questions. As you can imagine, this is again part of our efforts to reduce the burden of central banks in terms of replying all those extensive surveys. But we did have many open-ended questions, so the central banks can provide more nuance and context or why they think certain aspects are important or not important. And also importantly, there was an extensive discussion about confidentiality. So there are different levels of, I would say, confidentiality in this kind of cases. As you can imagine, central banks respond, and then they can agree on sharing the response among them, each other, sometimes not. And of course, how much we can publish those central bank specific responses. And we try to make it very clear, this is internal affairs, and therefore central banks responses are individual central banks' names are mentioned only when the information they provide in the survey is also publicly available. I think this is also a very important aspect. We want it to be clear the central banks do respond, what they're really actually doing without worrying about what they're saying or they're doing internally is sort of being open to the public. That was not the intention. So I guess overall, the whole exercise, we really try to get sort of, I would say, balance between the central bank's very frank and candid response. And at the same time, we also wanted to give a very much high level overview. So the other central banks, when they see it, they get a clear feel of what are the sort of average practice or general practice among the central banks. So maybe let me stop here, and my colleague Eduardo Amaral will walk you through the different sections.
Well, hello, everyone. Thank you for the invitation. I'm Eduardo Amaral, and I will proceed with presenting the different sections of the survey on monetary policy under high uncertainty. One of the first things the survey explored was how central banks measure and understand uncertainty. This graph shows the relative importance of different indicators used by central banks to identify periods of heightened uncertainty. As you can see, financial market volatility stands out as the most closely watched indicator for that purpose, followed by forecast errors, qualitative judgment by staff or internal committee, and confidence indices such as either consumer, investor, or producer indices. Other sources of information that are used by central banks include feedback from businesses, community contacts, and also the depositors' behavior that they observe. In this section, the responses to the survey also pointed that high-frequency data is particularly valuable as it provides real-time insights to central bankers. However, it comes with some challenges, such as high volatility of the data, gaps in coverage. This time series tend to be shorter since their collection has started more recently, definitional inconsistencies with respect to more traditional indicators, and the need of more advanced technological infrastructure and skilled personnel in the central banks. Interesting to note also that having different measures of uncertainty seems advisable, as they do not necessarily commove, and there's no single indicator telling the whole story of what's going on in the economy. Not all financial market volatility actually reflects what's happening in the real economy. Concerning the tools that are used, it stands out that many central banks use macro risk models, which help account for extreme scenarios with asymmetric probabilities. Now, let's talk about alternative scenarios, which are especially important during periods of heightened uncertainty. We found divergency among central banks about whether the central scenario becomes more or less relevant during times of heightened uncertainty. In the board discussions, there is more attention that tends to be given to scenarios with quantifiable likelihoods and to known unknowns. The unknown unknowns or fundamental uncertainty are much harder to address, so they are less frequently discussed in these meetings. The differing views regarding the importance of the central scenario seems to be related to the source of the uncertainty. If the shock is large and realized, past data may lose relevance due to structural breaks or nonlinear effects. But if the shock is expected but not yet observed, scenarios are useful for internal discussion, but very hard to communicate to the public. In cases of extreme uncertainty, the central scenario often serves as a critical anchor for economic agents who need stability and predictability. What would make them more important in this case? So here we have different visions about what happens with the importance of the central scenario depending on the nature of the shock. Next, let's look at how central banks incorporate uncertainty into their models and tools. Respondents to the survey have mentioned that structural models, statistical methods, and expert judgment all play a role. Additionally, they mentioned that scenario building has become a key tool for analyzing uncertainty and presenting it to decision makers. When building the scenarios, the respondents said that they often focus on risks like tail events or nonlinear effects that standard models might miss. Several of the central banks that responded to the survey, they also recognized the limitations of their models, especially when dealing with unprecedented risks or structural changes. One curiosity that we found is that half of the central banks do not provide probability distribution around their point forecast when they make forecasts to the board. I found this quite interesting because apparently incorporating even statistical uncertainty seems to be perceived as either excessive information or hard to grasp, even for the most specialized audience there is, which is the board. Concerning challenges, we found that one major challenge is distinguishing between structural shocks like supply-side disruptions and cyclical shocks such as demand fluctuations. For tackling these challenges, central banks rely on different types of models such as VARs with sign restrictions, Bayesian VARs, and all sorts of models. Another challenge is addressing uncertainty in the monetary policy transmission itself, in the mechanism, particularly the relationship between the output gap and prices, and also exchange rate dynamics. Concerning the use of more advanced techniques, many central banks are currently exploring the use of AI, machine learning, and neural networks into their economic analysis and forecasting process, although only few of them have already incorporated. So it's more of a frontier at central banking than actual current practice at the central banks. It's really something that's being explored right now. We also found that depending on the nature of the shock, central banks create new indicators or aggregations of core inflation that seem more meaningful given that specific shock. So the toolkit of central banks, it keeps adapting to the shocks that the central banks actually have to deal with. Moving to scenario analysis, this is a critical tool for exploring potential outcomes and preparing for the unexpected. Among the main key shocks considered by central banks for creating scenarios, we see in the graph, which is extremely influenced by the conjuncture of 2025. I must say. We have trade and tariff, as expected, exchange rate, oil price, and inflation surprises. Moving to the sources of uncertainty for the construction of the scenarios, here related to levels of input variables or their elasticities to the shocks, and also counter policies in the case of tariffs being posed by a foreign country. We have inflation, exchange rates, trade and tariffs, and output gaps. How central banks actually prioritize which scenarios they're going to build. Scenarios are prioritized based on their importance to the board and their macroeconomic impact, followed by their likelihood and sometimes even their prominence in the media. So how uncertainty actually shapes monetary policy decisions? We found that it has a significant impact. Although it does not enter directly in the monetary policy reaction function, it does affect it indirectly. We found that central banks often take a cautious, incremental approach during periods of high uncertainty. This allows them to adapt as new information becomes available. The main motivations are, as you can see in the graph, guaranteeing some predictability for economic agents. That was the most cited reason. Then we have financial stability, very close to the first one. And then we have uncertainty about the future events and about the very own transmission of monetary policy. Then we have some other reasons that have been cited, which are main variables in the monetary policy reaction function. They move slowly, avoiding panic, misinterpretation, or extrapolative behavior. And a few central banks also mentioned the reputational risk of the central bank and also mitigating redistributive effects. Not many have mentioned that. We know that it's not clearly as a mandate of most central banks, redistribution. So it was not very cited. We also found that central banks adapt their strategies in times of heightened uncertainty. They do so using alternative economic models and changing the frequency of communication with the public. As we will see later in a section specific for communication strategies, we found that no central bank actually reduced the frequency, while some have increased it. Some central banks communicate pauses in the policy rate adjustment to assess transmission effects, which is something they do as usual in any kind of a level of uncertainty, while others adopt a slower pace of action to maintain room for maneuver in case the scenario changes abruptly, mitigating possible reputational risks. There are also differences based on the inflationary history of each country and, of course, the initial conditions of each country. You're probably aware that in Latin America, we have a recent history of chronically high or even hyperinflation. And I refer here to the 80s, not so recent, but still recent. Almost all countries have solved this problem, but the memory of these times in history, they do remain. This influences on how much room central banks in the region have to adjust, wait and see the conjuncture unfolding. For example, in 2024, the Bank of Mexico gradually reduced its reference rate to balance disinflationary trends and weak economic activity. In contrast, Argentina, with its history of high inflation, even with activity decelerating very quickly, it took a much more aggressive stance to avoid inflationary surge. So moving to forward guidance communication, we have a specific section on that. We found that central banks perceive forward guidance as a valuable tool for managing expectations, but its effectiveness varies depending on the level of uncertainty. The key insights here are that forward guidance works best in low uncertainty environments. Its effectiveness reduced monotonically here with the level of uncertainty, which is an interesting finding as this was not obvious to us when we prepared the survey. We also found that during high uncertainty, central banks often react by shortening the time horizon of the forward guidance, or they provide ranges instead of point estimates, or still they avoid giving any forward guidance at all. So how much forward guidance central banks are willing to provide is state dependent on the current level of uncertainty. One interesting observation is that forward guidance seems to help mitigate uncertainty related to the central bank's reaction function. For example, what's the current level of the neutral rate or the perceived level of the neutral rate according to the central bank's members? But it risks locking the central bank into unfavorable positions during external shocks when uncertainty is not actually in the hands of the central bank. So communicating with the public is the last section of the survey. We asked central banks what are their communication strategies. The message here is that communication is hard. All of them said it was hard. None of them said it was an easy thing to do. But apparently communicating uncertainty to the general audience or to the public is harder than communicating it to the specialists. There's always a risk of misinterpretation, especially when people tend to focus too much on point forecasts, ignoring all the risk there is around them. Concerning the tools used for communication, central banks have been using fan charts, scenario analysis, and qualitative assessments to convey uncertainty. During crisis, they may also adjust the frequency of communication, as we saw during the COVID-19 pandemic. More communication is not necessarily better, but actually none of the central banks, as I mentioned, has reduced the frequency. Some other strategies include publishing alternative scenarios and qualitative descriptions, suspending the central scenario, and assuming that we are under 19 uncertainty. That was a strategy adopted by Central Bank of Colombia during the COVID-19 pandemic. Publishing a balance of risks, which is, for example, the case of Central Bank of Uruguay. And this is public information, of course. They not only publish a balance of risks, but they also attribute probabilities to those risks and degree of severity associated with them, which is an extra mile compared to what most central banks actually do. So to wrap up, the survey highlights how central banks are adapting to an increasingly uncertain world, a more shock-prone world, perhaps. While uncertainty isn't explicitly built into monetary policy reaction functions, it does influence almost every aspect of decision-making, from modeling and scenario building to communication. Central banks recently have shown remarkable flexibility in adjusting their strategies to meet this challenge. And with these remarks, I finish the presentation and thank a lot for your attention.
Steve, over to you, and Hans, over to you.
Okay, I'll just, well, thank you very much for the very clear presentation. I just have one little preliminary question about the survey and how central banks think about scenarios which are perhaps highly unlikely, but if they would happen, they would have large effects. And do central banks say that they have in their drawers, so to speak, contingency plans, even though they don't even communicate what they are? I remember very clearly when I was at the Hong Kong Monetary Authority, there were such contingency plans, and they were super secret. So, and I'm not going to say anything about them other than that they existed. And I would presume that central banks still do have such plans in their back drawer, so to speak. Did you ask about that in the survey?
Eduardo, maybe you can. Yeah.
Sure. What they answered to us was that internally, they do have lots of scenarios that they do not actually communicate to the public. So communicating a scenario to the public is a strategical decision. The idea is to actually influence expectations or to reduce the uncertainty related to the monetary policy reaction function. But internally, they do have extreme scenarios. They have all sorts of scenarios. But these types of scenarios, they cannot be disclosed to not generate panic or extrapolative behavior. So what the answers from the respondents that we had, what they actually mentioned was that what they tried to do is to prioritize the scenarios that are important for the board for some reason. Maybe a specific board member is interested in a specific scenario, and I believe it's related to the perception of the balance of risks that the board has. And also, of course, the likelihood that the scenario will happen is important, and the macroeconomic impact, the actual impact on the economy, if it's a catastrophic scenario, it is analyzed. But we must have in mind also that catastrophic scenarios usually they are harder to predict, and also harder to predict the consequence, and even, I believe, harder to model.
Let me, we do have two discussants. And so let me suggest that that we turn to the discussants now, and then we can have more general questions from the other participants. The two discussants are Anil Sharma and Shashanka Bhide, and let me turn to Anil first, if I may.
Thank you, Mr. Stephen. I have three observations, one general and two pertaining to the communication aspect. There is nothing much to disagree with regard to the findings of the study. That is the impact of the uncertainty on the monetary policy decisions. However, if one steps back a little, then one realizes that uncertainty is the only constant every 4 to 5 years. You have current geopolitical and supply chain induced uncertainty. You had COVID-related uncertainty a few years back. Then you had European debt crisis of Portugal, Italy, Greece, etc. You had Western financial crisis a few years before that in 2008. You had dot-com burst and Enron-related scandal-related crisis a few years earlier. You had Southeast Asian crisis. You had Barings Bank's collapse, which shook the markets. And then in 80s, you had in America the savings and loan, crisis. So, and possibly we can go back right to our cave days when there was uncertainty with regard to our life and our food. So, so therefore, certainty or uncertainty rather has been so certain and regular in our experience that it is time that it gets explicitly embedded into the monetary policy reaction function. So, so it should be a norm than an exception which we should be trying to address and provide for. And I'm sure most of the central banks have taken this persistent uncertainty in their stride and built a number of techniques and models to provide for this uncertainty. Some of these steps in the models have been spoken of as well. So while known unknowns can be provided for, it's very difficult to provide for the unknown unknowns, as the paper mentions about these. With regard to the communication, as Mr. Charan mentioned in his opening remarks, the communication, looking at the complexity of the transmission channels of the monetary policy, it's a time-consuming process. It takes time to for the communication to flow and the impact of the monetary policy actions to be transmitted to the channels through various markets. In India, the issue of communication is largely addressed through speeches, interviews, and stakeholder communications. In addition, in the recent years, the stance of the monetary policy also has been communicated explicitly to the market participants, along with the forward guidance is also adding to the clarity of the communication. As a result, we have seen that the communication and the resultant transmission of the monetary policy in the recent years, as the published data shows, has been not only faster in fact, and it has been also transmitted almost fully or substantially in most of the cases. There have been variations, however, with regard to the transmission of a rate cut vis-a-vis a rate increase. driven largely by the market conditions and the market liquidity, etc. But largely the communication is much more clear and transmission much more faster. And finally, ideally, as Mr. Stephen pointed out, ideally markets should respond to the data than to the statements of the monetary policy authorities. But it is unlikely, as there are just as there are no perfect markets, the stakeholders' perception of the understanding of the same set of data published by the Monetary Policy Authority may vary substantially, leading possibly to greater market volatility. So for some time to come, in my perception, we will have to stay with the monetary policy statements in addition to the publication of data. So I'll stop here and would be happy to come back in case time permits.
Thank you very much for those very nice comments. And now we move to the second discussant, Shashanka, please.
Thank you, Stephen, and also thank you, Dr. Charan Singh, for this opportunity for me to be here. And I should say at the beginning that the presentation and the background paper that I saw, the BIS paper, is very comprehensive and provides us a review of how the central banks in different regions have looked at this issue of uncertainty in monetary policy making. So I should congratulate the authors, I think, for this very comprehensive review. And I guess as I think as Stephen, I think, had said, and also now Dr. Anil Sharma also has said, uncertainty has always been there, and it's something that the policies are supposed to address. So I just wanted to mention two questions, I guess, before I forget. I mean, general questions, I think, to the authors. One is that it's difficult to sort of comprehend what kind of models are used by the central banks. Because I think, my own perception is that, as someone said, they're fairly resource intensive enterprises, I guess, to undertake. And given the fact that the uncertainties may arise from different sources, I think it's hard to implement the implications of such uncertainties, I think, at the macro level. So I think one question I think is actually, how simple or how complicated are these models to implement? And the second question is that, since we're doing this management of uncertainty over time, how well have we done it? I think so. Is there any way to say that? So different countries have different experiences, I think, in handling uncertainty. So, how have we fared? I mean, so that is something that is important, because I think your paper also points to a lot of variation in the way the uncertainty has been managed. So I think that these were the two general questions that I wanted to ask. So the other comments that I want to make are a bit more, more from the perspective of the Indian context than the paper. Your paper is addressing. Obviously, I think that the basic features of the monetary policy decision making affected by the uncertainty that you mentioned are also the same, sort of experience, I think, that the policy decisions in India also. So one common sort of element in what I'm going to be saying is that uncertainty is essentially because of unpredictability of the environment. So I think it is this issue of unpredictability, and I think how are we managing that in our in our decision making process, right? I mean, so we have talked about different ways of doing that, but if unpredictability is the uncertainty, then are we reducing this this unpredictability, or are we improving our predictions of future events? And how are we managing our systems to deal with this uncertainty? So for example, I think the inflation targeting regimes, right? I mean, I think so. Obviously, in the Indian context, I think we have this flexible inflation targeting. We look at both inflation and also the growth scenarios, and so the predictability of future, both in the context of inflation and growth. And I think so. There is as you said, there is one central scenario or baseline scenario, and then there are these uncertainties. I think the things that we have not considered. So this, from what I have understood, I guess the uncertainties are probably more sort of more common with respect to the global influences now. But I think the countries like India have faced uncertainties much more often, I think, in the domestic context. So the standard uncertainty we have always faced is the weather conditions, right? I mean, so I think while it may not be terribly important, I think, in the context of the growth effect, it is terribly important in the context of inflation, right? I mean, so I think in terms of improving the predictions or the forecasts of even of the central scenario, I think that is quite important. And I think in the Indian context, again, I guess managing the uncertainty is in terms of improving information, right? I mean, so information about what's happening in the economy. So it is the high frequency data, but I think high frequency data, I think it is the focus is much more on the real sector rather than just on the financial sector. So I guess that's my reading of the the assessment of the overall economic conditions in the monetary policy discussions. And similarly, I think a lot more focus on the domestic scenario compared to the global scenario. It's not to say that the global scenario is not taken into account, but I think the domestic conditions are looked at far more closely, both in terms of what they mean in terms of consumption, what they mean in terms of investment, and the fiscal scenario, and so on. So I think the sources of uncertainty and implications to monetary policy, I think, is something that the external factors, I think, is a lot more sort of assessment of an expert's assessment, subjective assessment, rather than, I think, in terms of incorporating them in the model. So I guess that's something that I felt was important. So the exogenous factors which are sort of expected to affect the economic conditions, as for standard, I think, in the way that the other central banks have also mentioned. So the oil prices, for example, are a sort of an important variable, I guess, that is considered in terms of affecting the central scenario. And in the Indian context, I think it is the weather conditions that is important. And I think in a number of ways, I think the government policies are more important. So the government policies with respect to prices, with respect to trade, with respect to investment, I think these are the areas which are which also introduce, I think, uncertainty in the market. I mean, while there are policy sort of policy statements, I think, which provide more stability, but I think there are also new policy initiatives that come that also affect the central scenario. I think the case in point, obviously, is the with respect to oil prices, for example. I mean, so there is the transmission from international sources or international scenario to the domestic scenario, that depends on the government policies. I mean, while the markets do have a role in transmitting that to the domestic markets, but I think it is so. It is these additional factors, I think, that come into play, I think, in looking at the alternative scenarios affecting the macroeconomic conditions. So I think, the assessment of information, the surveys that the central bank undertakes of households, of enterprises, including, I think, the experts on the emerging economic environment, they obviously provide information on the, at least in the short-term context, I think. They probably do not play a great role, I think, in the sort of medium-term context. The assessment or the alternatives scenarios, I think, are also important, I think, in making an assessment of the medium-term environment. But I think so I'm interested in knowing, so therefore, what variation is there in different models used by different central banks. And I think a few other points, I guess, in the Indian context. In the Indian context, one important sort of change, more recently, is that there is a huge improvement in the data front, on the data front, right? I mean, I think one source of this uncertainty or inability to incorporate the impact of uncertainty is the data. So we now will have an updated national accounts data. We will have an updated price data. We have updated industrial output data and so on. So I think the ability to make an assessment depends a lot, I think, on how good the data is. And so I think there's one issue, again, I think, which is important for us. And I think the last point I wanted to mention was I think so. We talked about uncertainty, and dealing with uncertainty. But one other word, which comes very often is the resilience, in the sense that, what is the impact of this uncertainty, and then how do we deal with that uncertainty? So how quickly we sort of come back from the negative impact of the shock. So is any variation in the policies that we have to the in response to the shock? So that assessment, we should be in a position to make that assessment. And the models that we build, I think, should be able to provide an assessment, I think, what builds this resilience. Because many of the, a lot of analysis that has been done in the context of the uncertainty with respect to either the global factors or domestic factors, particularly the global factors, I think. Now we look at the foreign exchange reserves, we look at foreign exchange reserves in the context of ability to manage current account balance, and the investment flows and so on. So I think that those measures of protection from vulnerabilities, I think how do we use them to say that the resilience of the economy to overcome the shocks of uncertainty. That's something I think is missing at this point. So Charan, these are the comments that I wanted to make.
Thank you so much. Let me turn back to the presenters, to Ilhyock and Eduardo, if you have any responses to those. There are a number of comments in the chat, which I will try and summarize into a set of questions in a moment. If anybody else wants to add to it, please feel free.
Thank you, Chair. Maybe, Eduardo, I can try to cover like 2 or 3 points, and I'm sure you also can cover the others. So let me first start from this point about global versus domestic uncertainty. I think this is a very important question, and already I guess the survey, that distinction has been clearly made. And instead of saying, I mean, what is the right way of central bank has been, but just to introduce one recent research from this office, BIS America's office, we do have this paper on thinking about the policy uncertainty context, because there's sort of a, I would say, smallish debate within the BIS talking about whether the uncertainty shock is a demand shock or supply type shock. I'm sure many academics point of view, this is a very important question. And the paper basically says, suppose you have domestic and foreign uncertainty, and you also analyze domestic uncertainty against foreign, meaning what is sort of a true domestic and what are the global or foreign uncertainty. And what the paper finds is in that time context, domestic uncertainty is like supply shocks. It reduces GDP growth, increase inflation. So there can be some specific channels and reasons, and I think we can go on. I guess the paper will come out soon. I think so in a week or two. But the main sort of idea is the uncertainty tends to increase what you can call financing premium for many corporates, in addition to other sentiment and other sort of effects. So that can be one way to explain this supply shock type outcome from the uncertainty shock. So indeed, central banks are thinking about it, and I'm sure the experience of advanced economies and EMEs could be quite different. But that's something that I wanted to sort of, I would say, highlight. And in terms of the, let me see, I think there was another one I wanted to mention. So in terms of model, I think there was a question about how difficult to incorporate models. And yeah, maybe I think Eduardo is in a better position because he has actually done this thing on the field. But what I see is important is the exchange rate, because let me just highlight that in LATAM, as you all know, exchange rate is probably the more important variable than even interest rates. Because most people, the public, they know what is today's exchange rate, but they may not know what is today's policy rate. So that's sort of the reality. And you can imagine if there's high uncertainty, the natural focus is exchange rate. And of course, that has implications on inflation, other stuff. So it's actually almost sort of natural. The central banks also pay attention to the reaction of exchange rate. Of course, exchange rate is a very complex animal. It's affected by all the financial forces and so on. But under times of high uncertainty, I think it's very important for central banks to pay attention to exchange rate. And I think that sort of comes out in the survey response, as we have seen in different places. So let me stop here, and I'll ask Eduardo to answer the questions.
Okay, thank you a lot for the questions. I will address the remarks by Anil and Shashanka. First of all, uncertainty is the norm in central banking. It's the bread and butter. It's always there. That's why we try to qualify this survey or restrict this survey to periods of high uncertainty. It's debatable whether we are now living more frequent times or succession of periods of high uncertainty if the world has become more prone to shocks. And I think this is behind is the backdrop also of why the survey was conducted. With respect to communication, it's true that the central banks, they are still trying to figure out what's the best way of communicating with the public. It's not clear if more or less communication is good or bad. There are several papers being written about it. And the amount of information that the central bank actually gives to the public, it must be thought as well how much confidence the central bank has on the information or on the signaling that it's providing. And that's very hard. It's like revealing what you know and what you don't know, and not trying to confuse the public, giving more information than actually it would be advisable. There is certainly a lot of variation on how central banks are actually responding to periods of heightened uncertainty. And I think we can give one example here. Last year, we had the tariffs that were imposed by the US on several economies. And if we think about the two of the most impacted economies, like Mexico and Canada, they reacted in terms of monetary policy communication with the public in very different ways. Canada provided scenarios specifically saying what would happen if Trump raised the tariffs up to a certain extent or not. But Mexico this time decided not to provide any scenario at all on that, which is a different approach that it adopted during the COVID-19 pandemic, when it clearly provided different scenarios. So there's not like a very clear science on this topic. It's really something that central banks are learning by doing. What I also would like to highlight is that one of the points that I thought most interesting that was raised by one of the respondents of our survey was that one of the biggest issues with communicating with the public is that, do we really know how uncertainty affects the economy? Do we really know how agents reacted to more or less uncertainty? And when the central bank decides to give information about the periods of uncertainty and about its reaction function, for example, is it really accounting the real way that people or the agents or the economy will react to uncertainty? So this is an area of a lot of unknowns, actually. And the central bank should be more careful as they are about providing, signaling more knowledge about the current situation than they actually have.
Thanks, thanks very much for that. There are several categories of questions. We don't have a lot of time, so I will. I have one question, and I'm just going to give you all of the questions at once as I've sort of grouped them together. So my question is whether or not you've asked or have a sense of institutional capacity, and what I mean by that is that that one of the ways to think about people doing what are sometimes called tabletop or crisis simulation exercises is that these are not about, well, and actually having dinner at the BIS also, these are not about actually being able to manage the specifics of that uncertainty, or not about being able to discuss specific cases with your colleagues, but about knowing how to work with them instead, so that when something happens, you're aware of whose job is what. So I'm reminded of what I know happened in 2000, and it was the late 2007 with the institution of the original swap lines that the U.S. had. There were telephone calls between people at the Swiss National Bank and various other places in the Federal Reserve that I actually saw some of them, and the people that were involved knew each other quite well. So that was important, that they knew each other and they knew who it was that was in charge of what. So I was wondering whether or not you had something about institutional capacity and in dealing with, because this is how you deal with what you guys refer to as unknown unknowns or radical uncertainty, is by having institutional capacity and having a knowledge of tools. Let me divide into three the various questions that we have here. The first category is about measuring uncertainty, and there are two issues here. One of them is about alternative measures, how it is that that people are integrating alternative measures of uncertainty and what they are. And related to that is the question about what happens when there are conflicting signals from different sources of uncertainty. So the example that one of the audience participants gave was that the VIX is sometimes the VIX is really low, and that uncertainty is actually quite high. So what do you do about that? The second one is about how to make adjustments in frameworks, whether people discussed how they were adjusting their frameworks going forward as uncertainty and the sources of uncertainty especially changed. And the third one is related to the final point about how they manage changes in the sources of uncertainty, and I guess and what it is that people are doing as those change, and I guess there's yet another category of questions which I find very interesting, which I'm not sure quite how to ask, but the way that I tried to summarize it in my notes is about the relationship of sources of uncertainty to objectives. So will your objectives as a central bank be changing as the nature of the uncertainty in the economy changes? And will you, so, and then obviously in all of these, there are issues of communication. Let me stop there because we only have 7 minutes left in our allocated time. And I apologize to all of the participants whose excellent questions I've not been able to answer, but they're in the chat for everyone to look at. And you can also then evaluate whether my interpretations are correct or not. So thanks again.
Can I just add one more thing, Steve? Because I think what you said about objectives is really important. Whether objectives are changing when the perception of uncertainty is higher, and if they are changing, to what extent, how they are changing. Is it moving from inflation towards output towards other objectives? And I think that is very important.
Yes, Eduardo, maybe I can try to answer a few, and also you can pick up the others. So regarding the question on VIX and MOVE, I do see the question in the chat. And this is a sort of a easier question because BIS over the last 10 years has written a lot about this. The dollar is the more effective measure of uncertainty than VIX, and there are many reasons why VIX has sort of lost power. Some are related to why it's traded. It's traded uncertainty sort of gives a lot of bias, and then the stock market, as you understand, is moving very differently from general financial conditions globally everywhere. Now there's other idiosyncratic reasons. So for many reasons, I think VIX move may not fully capture. This is sort of a bigger question last year about this, what you can call perceived physical uncertainty, or the noises what you hear from the press versus how market sees. And market has apparently figured out that a lot of noises are really noises. So that we can go on and on this, but I think this is a fair question, but that's important, what kind of uncertainty we are talking about. But I do remember there was one comment, eventually what matters is real economy. So how much real economy is affected by the perceived level of uncertainty. So that's sort of what we are, in the central bank's point of view, that's very important to mention. And in terms of the objectives and then the tools potentially and the uncertainty, yes, this is an important question. And typically what central banks and also the BIS has been working on is, okay, objectives do not suddenly change. That's what central banks mandate. That's rooted in more institutional and legal aspects, and central banks have to deliver. So uncertainty generally makes this policy mix in a very complex way. I can imagine you can say supply type shocks, as I mentioned before, is a huge headache for central banks with achieving the sort of trade-off between inflation and growth. And then this external dimension, exchange rate, others, add to additional layers of trade-offs. So trade-offs become even bigger on the high uncertainty, and that gives more challenge to central banks. And also at the same time, I think someone mentioned the government's role, meaning we're talking policy mix, fiscal, central bank, regulatory actions have to all work together in this hugely complex, sort of high uncertainty environment. So there has been a lot of discussion going on, and this is not the first time. In COVID time, there was an active discussion. I think Hans may remember, central bank in Asia wanted to figure out how to cope with that unusual uncertainty and shocks. And there's been active discussion about policy mix on the extremely high and unusual uncertainty. So I guess that kind of discussion will continue. But let me stop here. I guess, Eduardo, you can also try to answer.
Okay, so regarding the question on institutional capacity, from the survey responses that we had, they didn't mention specifically this specific case in which you get to know other institutions or how you're going to react better, because you know what everybody does, and where are the tools and the people with the knowledge, specific knowledge that is useful for dealing with that specific situation. But we had answers in the sense that considering that uncertainty depends on different types of models for being measured or for being understood, there was this. There was several central banks that mentioned that there's a limited capacity in terms of personnel, of staff, and because these are skills that must be developed, and these are reasonably recent skills. So knowing how to create an AI model and how to write adequate prompts, the best prompts for retrieving the best of these models, this type of things are actually a challenge for central banks right now in terms of institutional capacity.
Thank you. Thank you very much. I'm going to turn it back to Sharon.
I must thank both of you, Steve and Hans, for chairing this wonderful session. I think it's very complex, and handling uncertainty, the unknown unknowns, we have seen it in the last 15 years, especially from 2008 onwards. If you see, it's been all over the place. And despite the fact that BIS does host the central bankers regularly, they meet, they discuss, but despite that, there are things which happen and none of us and nobody can really handle this. And these tailwinds and headwinds that are happening that further add to uncertainty. I want to thank both the speakers from BIS for having agreed to come and present their research with us, and both the discussants who have gone in depth and shared their thoughts. On a Friday evening in India, 6:30 to 8, it's dinner time, and we had about 75 participants during this discussion. That shows this topic of interest. Of course, my own experience has been on Saturdays and Sundays, and many people watch it. This has been a very educative discussion today. And I want to thank each one of you profusely for being with us. But please remember, we have achieved something very unique today. We have had people from across the planet discussing together something very, very important. In our own country, the monetary policy is being discussed next week. Our union budget, it's a major event in our country, is being presented on a Sunday. And then on February 6th, we are having the monetary policy. Our annual monetary policy will be announced in April. So the timing of this discussion is extremely crucial for us. And I want to thank the two speakers from BIS for having agreed to come and do this presentation. Steve is also from the BIS, and you could see the richness of his discussion because he knew exactly how BIS operates. Hans, my own dear friend, has been in this area in Malaysia and the Central Banking Institute now. So he knows in our area how things happen. And of course, he was with the Hong Kong Monetary Authority. So I want to thank each one of you. This Friday webinar series next week is hosting something very amazing. Many of you may be interested in it. In India, we will complete 100 years of our planning and independence in 2047. We got our freedom from the Brits in 1947. Indonesians got it 2 years earlier. While we are planning for a developed India 2047, Indonesians are planning developed Indonesia 2045. Next Friday, we have a detailed discussion from a professor from Indonesia talking to us on how they handled their economic growth and what are they planning for the next 2 decades. so that they achieve the developed Indonesia status. I would welcome you all to please come and participate in that webinar. And once again, have a great weekend. Look forward to meeting you again at this webinar series and thanking you once again for being with us on a Friday evening. Steve, thank you very much for starting your day with us. And so is true for both Eduardo and Dr. Shim, that you started your day with us today. Have a great day ahead. And Hans, I know it's close to 10:30, 11. Look forward to interacting with you again over the next few days. Thank you very much. Thank you, each one of you.
Thank you.
Thank
Thank
you.
you very much.
Thank you.